How's it going, guys? I'm just I've been trying to find this and this. Not even sure if this is the right one, so I have to figure this out.
All with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others.
So weird, I
across the
cannot
nation
hear
to
them at
address
all.
housing
Can you guys hear
problems,
them? Can you
promote
hear what they're
equal
saying? Those
access to
people in that
credit,
little
advance economic and community
box there?
The Fed also promotes
I'm
stability in the
gonna see if
financial
I
system,
can
because instability in
find
the financial system
out.
poses a severe threat to the broader economy and communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we
are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Oh, you can hear them? Okay. Oh, you can hear them? Okay. All right, there we go. Yeah, so I mean, I think we all are kind of expecting the same thing is, well, that's the thing. So we're all expecting, you know, nothing to happen. So it'll be interesting. The thing that I think that'll matter, and it may not even move the markets much today, but I think it's just going forward what they're gonna, you know, what they're gonna be saying about the future, where the things will be pushing, you know, et cetera, et cetera. So 'tis what I will be waiting to see. Obviously, if there's something drastic, then stuff's gonna get crazy, but be interesting. Even just leaving it alone is interesting to me because, like I was telling you guys the last time we had this meeting and we were on here, it's only a matter of time before this catches up to the banks. And with everything else going on behind the scenes, I'll also be very interested to see what Powell has to say. The other thing, I might get a copyright strike for it, but maybe we just do it for today and who cares. Peter Schiff is speaking on Fox Business after this at 3 p.m. I know he's very, always pretty much a permabull, but it'll be interesting to see what he has to say too. So I might be watching that after this, depending on how long this takes. So imagine this is, you know, so see, it says 2:30 though, and they kept telling us 2. So is that true? It doesn't start for 30 more minutes? Yeah, I swear they said, yeah, it does say 2 everywhere else. Weird that it says 2:30 here. That's okay. And then, yeah, like I said, after that at 3 p.m., Peter Schiff is talking on. So that does kind of overlap, but I might flip back and forth between the two and just see what he has to say. I like listening to his outlook. He's a pretty intelligent guy. Obviously, he's very, very biased. He's always been pretty much a perma-bull. He talks down on crypto like it was the devil itself. But I do like listening to a little bit of what he has to say from time to time. So that will be interesting just to see. He's like the it's like the anti-Kramer. So in the meantime, yeah, so today's basically been like we were saying, guys, just, you know, going to be chopping around. Anticipated all of this. It was pretty much exactly this. I would have been surprised otherwise. The one thing that I think will be nice is once this is kind of done, obviously we'll get some forward-looking statements, which will be nice. I think Trump will have his, not his questions answered necessarily, but he'll have a little bit more to go on for this weekend with the tariffs. I do think he was going to delay them anyway, so it'll be interesting to see if he doesn't do that based on whatever happens today. But then also it'll be really interesting to see, not today, but after today, if maybe we can get some volume back into the market and things start to move from here, like after this is out. Fed holds interest rates after what does it say? Fed holds interest rates after 3 cuts in 2019. Word. Feds leaves it unchanged. Breaking news. Okay. Well, yeah. Just in, Fed leaves rates unchanged. Surprise! Yeah, well, that's exactly what we thought. I think it would have been crazy had it been anything different, but still, I want to see what they're going to say. It'll be interesting to see. And like I said, it'll be interesting to see the rest of this week, and especially into next week. If we can, some volume starts coming back into the market, starts moving things around. That'll be super, super interesting to me. Hold on, I've got all these other guys in the background talking on the other news. I want to see what they're saying here. This guy's got a bow tie on Yahoo. I need a bow tie. People take me more serious if I had a bow tie. So the only thing that they're saying has been changed is they're just saying some of the wording in the middle ground of the Fed statement has changed. That's the only thing that has changed. So it'll still hold steady at 1.5 to 1.75, saying inflation looks good, blah, blah, blah. Here, I'm going to go ahead and pull this up and read this. Here's what changed in the new Fed statement. And this is a comparison of Wednesday's Federal Open Market Committee statement with the one issued in October 30th after the Fed's previous policy-making statement, or meeting. Text removed from the September statement is in red. Okay, blah, 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 blah. So I'm just looking through this. There's got to be something in here interesting for us, guys. Give me a second. Fed rates are appropriate to support job growth rates. So, I mean, some of this could be considered sort of, not necessarily bullish, but positive that it's going to stay, that they weren't going to go backwards or anything like that. So, I mean, you can kind of see the market kind of, grinding up a little bit here, but they're going to be as guarded as possible today. I mean, Powell doesn't want to screw up a good year. I mean, this has been a fantastic year for the market, especially considering what happened at the end of last year. I mean, last year we were doing pretty good so we had a huge issue in last February. And then the market regained and rebuilt and got stronger and stronger. And then when they added again at this meeting last year, the market it sent a spiral. This is what started it all last year, and it plunged all the way to Christmas Eve, and that was the whole Christmas Eve crash. And then we had to rebuild, right? So we've had a fantastic year, 2019. Like, I mean, amazing, really, by most standards. So I don't see them being anything but guarded today. I mean, Powell's not going to want to screw this up because we all know that Trump's going to put it on him, right? And honestly, it would be sort of on him at this point. Really what they should do if they want to screw anything up is they should probably leave it alone right now, and then starting in 2020, then, because then they've got a whole year, right, where they can blame it on this guy, blame it on him, blame it on the election, blame it on impeachment. They got all sorts of other things. But right now, with 3 weeks to go, I mean, they're going to be as guarded as absolutely possible. It will be interesting to see what comes out of Powell's actual mouth when he speaks. I'm sure it's going to be very just literally as neutral and biased as absolutely possible it could be. And I don't want to be chasing anything. I mean, there was, you could have hopped in a little trade there, but we'll see if volume can pick up for maybe a late day break. I mean, that's a possibility still at this point. That'd be interesting to see, but I just, yeah, so signaling it will keep them on hold through 2020 as tame inflation increases. And it is interesting with what's going on in some of the other countries. I mean, Germany's looking at a massive recession. France has, there's just something new every day in France with social unrest. Most of Europe is just absolutely hanging on by a thread. I mean, we all know all the stuff with Brexit. There's been huge issues in Italy with all that. There was a bunch of banks that were caught up in some huge, appropriation scandals. There's huge issues with what do they call it there? I can't even remember what it is right now. I'm reading and listening to 3 different things, like trying to talk. I'm just looking through this Fed statement here. Following the third rate cut at its October meeting, the Fed cooled expectations for further easing, insisting that monetary policy would remain on pause unless there was a material change to its outlook, particularly on inflation. Federal Reserve operates under a dual mandate to achieve maximum employment and ensure the pace of inflation remains contained. While the labor market has remained tight, underpinning the strength of consumer, the pace of inflation has continued to fall short of the Fed's 2% target. The most recent reading of the core PCE index, the Fed's preferred measure of inflation, came in at a 1.6%. The unemployment rate is at 3.5%, the lowest level in 50 years. Wow, that's crazy. I don't know how much of that is actually true, but traders are expected to shift attention to Fed Chairman Jerome Powell's press conference at 2:30 for more clues on future monetary policy action. Okay, so that's what's going on, and that's what this is. So there was no way to actually see in on there. Okay, I got it. I got confused. I thought they were actually going to have a speaker talk about rates, but so I guess they'll just have Powell speak, and it would probably be kind of open format like it was last time. That'll be also interesting to see if they can get some good questions in there from the audience. Man, I would love to be at one of those just to see how it really all works. I've never been to anything like that, so, and I'm sure it's way different than when I watch it on here. Strong November jobs report released last week will provide plenty of recent cover for Powell to continue to guide that the U.S. economy is in a good place. We're not convinced that the easing cycle is necessarily over going forward, but at a minimum, an extended hold period lies ahead. And I think that's what they were saying last time too, is that they didn't expect any other, there wasn't going to be obviously absolutely no rate hike, and then they were saying that there was very unlikely to have a rate change this year, but they were saying that possibly they would be looking at a rate change next year depending on inflation. So I think that's where that kind of stands.
The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed?
The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation. The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate.
The Fed also includes 12 regional Federal Reserve banks located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather economic information from all over the country
to help the Fed both monitor the economy and get the broad input necessary
to develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions.
all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Never actually watched through that whole little thing. That's funny. So just checking some of the other stuff, guys. So Skyworks is still up 4.5%. Qualcomm is still holding steady at 2.4%. Cirrus Logic 1.87%. So the alternative semis leading the charge today as far as my watch list goes. Bava coming in at 1.8%, Twitter at 1.73%, Tesla at 1.6%, Netflix at 1.5%, Baidu and Beyond both about 1.3%, Nvidia at 1.2%, Activision, Disney, Cat, Apple all about 0.7 to 0.9%. Gold still up about 0.6%, Starbucks up 0.5%. Facebook about 0.5%, Amazon and Shop both about 0.24 to 9%, and AT&T up about 7 cents. As far as on the other side, not too much red actually on my watch list. The VIX is down 2%. Home Depot still holding around 1.8% down. UPS 1.3%. Oil down. USO is 1.1%. /CL crude, light sweet crude is down about 1%, and Roku down about 0.46%, and Costco down just about 0.25%. Target also is down 0.17%, and Boeing is pushed up a little bit to be down about 0.14%. So Walmart and Target both down, which I'm just surprised that. I mean, it's only down a tiny bit. Like Walmart's only down about 17 cents and Target's down about 20 cents. Still just surprised just because I was expecting those to, kind of stay steady in the green, at least through till the holidays are over. The Fed also, by the way, just as a side note, reading through here, so it was a unanimous decision, which is always actually a good thing to see that they're all kind of on the same page, as opposed to being when they're not unanimous. It always seems like there'll be huge tension, and then so you get different you get different forward statements coming from each different region, and it just seems to really mess with the especially with the algos, because like you'll get the one person saying this and the next day this, and that happened, if you guys remember this summer, that happened where Powell had said one thing, and then I think it was the president from Cleveland and the president from, I think, is it Houston? They had completely different sentiments as Powell, and literally it moved the market. It made the market go crazy there for a couple of days, and that's where you get a lot of these people where they come up with that whole like, well, it's just manipulated, and why we don't have a chance. And I think that's where a lot of that comes from, where people get frustrated because they see that kind of thing happening. I understand. I mean, it does make it look like, I mean, I jokingly say this, but it almost reminds me of like the crypto market. Honestly, it's just you see some manipulation, but that's the thing, because that's why I always tell people, if the market was 100% efficient, trading wouldn't work. The only reason that we can trade is because there is an inefficient market. That's what makes you being able to trade. Someday in the future, when this is all run by algos 100% and it's 100% efficient, you won't be able to trade like this. I mean, it'll literally just be, the spreads will be 0.00001 cent, and it'll just be microtransactions times billions and trillions of it's why this works the way it works. Nothing has changed from this morning as far as myself getting in or out of any trades. I did not take any day trades today. I have not got out of any of my positions on Skyworks or Tesla. I'm going to let those Skyworks positions hopefully work for me and run a little bit farther. Depending on what I see this afternoon, tomorrow morning, I may be able to get out of them. Tesla, I'm definitely in for the long haul. I've got monthlies in January anyway on Tesla, so I've got a ways to go. I was looking at Starbucks and Beyond earlier. I don't know why. I just kind of persuaded myself out of the Beyond play. It would have technically been going against me right now slightly, but I would have had time on it. So yeah, nothing different there for me has changed. I am looking at contracts right now. I'm looking between SPX, SPY, VIX, and then looking at futures /VX /ES, and I'm just comparing the volume and the sizzle indexes and the call put ratios. So I'm just kind of looking for not necessarily clues, but just some indicators, maybe giving me some guidance as to what we might see the rest of today and the rest of the week. Just such low volume today. It was absolutely absurd. And I mean, I was absolutely expected, but it's just crazy when you actually go back and look, and it's just like, holy cow, like nothing, like just absolutely nothing moved. Yeah, and here come out the perma bears on on Twitter. So, ironically, was just talking about Peter Schiff because he's supposed to be on Fox Business here at 3 p.m. He says the Federal Reserve left interest rates unchanged at 1.5% to prop up financial markets and stave off recession. Since artificially low interest rates are increasing the imbalances in the economy and undermining long-term growth, current policy will make the next recession much worse. I mean, I have to agree with him slightly, but I think it's a little bit... the thing is we'll never see what we saw in 08. I mean, I think that we should see that, and it should be 100 times worse. But with the tools implemented now, they'll save it. They'll hit the circuit breaker. Everything will shut down for a couple of days. There's no way that they'll let it get that bad. So I just don't ever see that really happening. Yeah, there's a lot of people complaining. All these people they were probably the sell the news today, like I was saying this morning in pre-market, where they were all expecting, this thing was gonna. I don't know what they were expecting. I mean, it was obvious like it was gonna be the same thing. So I don't know why they thought it would just tank the market. I mean, if anything, I figured it'd be doing this exact. I mean, look where we started the day here. It's. I mean. 0.17 up. That's, like, exactly all we did was we dipped down for the middle of the day and we're back right where we started, basically. And technically right now, looking at, as I was just telling you guys, looking at SPY, SPX, VIX, and ES, there's still a higher interest on the put side, actually significantly at the moment. I'm not sure if it's just because we're back at that, what they call it, the max pain level of 3140, but it is actually significantly higher. So it's slowly starting to kind of balance out, but that's just, I think, because as we're kind of chopping around here. And again, I mean, Powell has the ability to say something that could absolutely make this thing rocket, but I don't think it's going to drop or do either. I think we're going to just chop around here for the rest of the day. But like I said, I want to see what he has to say going in for tomorrow, the rest of the week, into next week, because theoretically we could get some volume back and actually start to see that next leg up or more of a consolidation period. And I really think that we need a couple more days. I think this week should stay like it is, so that way next week maybe we could see that build up to the next leg, and then Christmas week we could actually see the all-time highs. And then coming out of that, I think we could kind of hover and consolidate around all-time highs, and then I think we would start to see the significant drop, because when it's just those big fast, like 1% in a day and then the next day those are too fast. They drop so fast that it's going to get caught, and it's usually more of a reaction than an actual signal. And so when it's slow and steady to the downside, that's when you get worried. Like that's when, and I don't get worried, I get excited because that's how I like to trade those. But that's when you start seeing real panic, where it's slowly and steadily going down for like 3 days, 4, 5, 6, 7 days in a row. When it's just 2 days, boom, straight down, it's almost every time. It's like 95% of the time it's caught. Like exactly what happened 2 weeks ago. And that's why exactly what I kept saying. And I mean, were we not exactly correct? It's what we assumed and anticipated. I mean, it's exactly what it did. Gold pushing up pretty good there. We hit a high of 1478.60. Bonds had moved all the way up to 158.25. We're sitting at about a 158.22, so up about 0.4%, which is pretty significant actually. XLF, the financials, like I was reading off the banks earlier, they're pretty much cut 50-50. But nothing up more or down more than basically a 0.3. So XLF still sitting at 30.27, so it's only down about 3 cents from yesterday's close. So that's holding steady, but the bonds and gold pushing up there pretty significant. So that still has a little bit of a bearish tone to it. Definitely be keeping my eyes on those the rest of today. See where we close out, especially after hours. Okay, guys, Powell should be coming on here any minute now. I'm going to be definitely eyeballing SPY and SPX here as it kind of drops a little bit more. It's kind of bouncing around at the moment as far as watching the volatility move around in the options chain. That's what I watch a lot too. So I'll have I've got the chart. I'll have charts on one side, and then I'll have the actual option chains open so I can actually see everything moving in correlation. I don't like to just look at candlesticks. I don't like to just look at option chain. I like to have kind of a little bit of everything. I don't know a lot of people that only watch lines or only watch candlesticks. I don't know really anybody who trades just off of options chain, but there's got to be some, I'm sure. But that's how I mean, that's why it sucks when you got like the one monitor and you're like flipping back and forth between like a chart with candlesticks or lines, and then going back and forth to the option chain. It's so nice having them both open. Okay, so I've got him up on Yahoo. Why is he not coming up? What the heck? He's speaking on Yahoo. Why am I not getting him speaking on her actual channel? There we go. Oh, this is like way delayed. He's already talking on Yahoo. The hell, FOMC? Bastards. I don't know who he's talking about. Somebody that passed away. Who?
Good afternoon, everyone. To begin, I'd like to say a few words about Paul Volcker, who, as you know, passed away earlier this week. Paul Volcker served as Federal Reserve Chair from 1979 to 1987. He accomplished many things during his long and distinguished career at the Fed and elsewhere. Of course, he's best known for leading the fight to tame the double-digit inflation that he inherited as chair, thus laying the foundation for the prosperity and price stability we enjoy today. But what is perhaps most admirable about him, more than his many accomplishments, was his character. He believed that there is no higher calling than public service, and he dedicated the lion's share of his life to it. With courage, integrity, and tenacity, he always pursued the policies that he believed would ultimately benefit all Americans. My colleagues and I continue to draw inspiration from his example. Turning to today's meeting, my colleagues and I decided to leave our policy rate unchanged after lowering it a total of 0.75 percentage point at the previous 3 meetings. As always, we base our decisions on judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. Our economic outlook remains a favorable one, despite global developments and ongoing risks. With our decisions through the course of the past year, we believe that monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and inflation near our symmetric 2% goal. The economic expansion is in its 11th year, the longest on record. Household spending has been strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. As has been the case for some time, sluggish growth abroad, and trade developments have been weighing on those sectors. Even so, the overall economy has been growing moderately.
Wow,
And
dropping
with a
pretty
strong
good
household
here.
sector and supportive monetary and financial conditions, we expect moderate growth to continue. As seen from
Geez, we're
FOMC
dropping.
participants' most recent projections,
He hasn't
the
said
median
nothing,
expectation
but
for
we're
real
dropping.
GDP growth slows slightly over the next few years, but remains near 2%. The unemployment rate has been near half-century
Sorry, guys,
lows
turn that
for
up a
well
little
more
bit.
than a year, and the pace of job gains remains solid. Participation in the labor force by people in their prime working years, ages 25 through 54, has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low and middle-income communities tell us that many who have struggled to find work are now finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and all levels of education. These developments underscore for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. We expect the job market to remain strong. The median of participants' projections for the unemployment rate remains below 4% over the next several years. Inflation continues to run below our symmetric 2% objective. Over the 12 months through October, total PCE inflation was 1.3%, and core inflation, which excludes volatile food and energy prices and is a better indicator of future
snap.
inflation, was 1.6%. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead to an unhealthy dynamic in which longer-term inflation expectations drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well and closer to their effective lower bound. As a result, the scope for interest rate reductions to support the economy in a future downturn would be diminished, resulting in worse economic outcomes for American families and businesses. Against the backdrop of a strong economy, inflation will rise to 2%. The median of participants' projection rises to 1.9% next year and 2% in 2021. We're strongly committed to achieving our symmetric 2% inflation goal. Over the course of the past year, our views about the path of interest rates that would best achieve our employment and inflation objectives changed significantly as the economy faced some important challenges from weaker global growth and trade developments. As the year progressed, we adjusted the stance of monetary policy to cushion the economy from these developments and to provide some insurance against the associated risks. In addition, inflation pressures were unexpectedly muted, strengthening the case for a more supportive stance of policy. Rather than modestly increasing the target rate for the federal funds rate this year, as seemed appropriate a year ago, we reduced it by 0.75 of a percentage point. This shift has helped support the economy and has kept the outlook on track. The median of participants' projections for economic growth, the unemployment rate, and inflation are little changed from a year ago, aside from a lower inflation projection for 2019. Of course, that is the function of monetary policy, to adjust interest rates to promote employment and price stability in response to forces acting on the economy. We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate. Looking ahead, we will be monitoring the effects of our recent policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the federal funds rate.
Well, then.
Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Finally, I wanted to note that we've been purchasing Treasury bills and conducting repurchase operations consistent with the plan we announced in December. These technical operations are aimed at maintaining an ample level of reserves and addressing money market pressures that could adversely affect the implementation of monetary policy. Our operations have gone well so far. Pressures in money markets over recent weeks have been subdued. To address possible pressures in money markets over the year-end, we've been conducting term repo operations spanning year-end. We stand ready to adjust the details of our operations as appropriate to keep the federal funds rate in the target range. Thank you, and I'll be happy to take your questions.
Howard Schneider with Reuters. Sorry about that. So I was struck by the sort of disconnect that exists here between the behavior of unemployment and inflation. You seem to have unemployment penciled in here now for 3 years running more underneath the longer run level, yet inflation never really accelerates. So what are we to make of that?
Well, that's what's happening there is the fact that the relationship between resource utilization or unemployment and inflation has just gotten weaker and weaker over the years. If you go back 50 years, you would have seen that when labor markets were tight and unemployment was low, inflation moved right up. And then as the Fed got control of inflation, the connection got weaker and weaker and weaker to the point where there's still a connection, but it's a very faint one. And what that suggests is that you would need to keep policy somewhat accommodative, and we believe that policy is somewhat accommodative. And we think that that's the appropriate place for a policy to be in order to drive up inflation.
Follow up on that. I mean, it's faint and non-existent, though, it seems to me. So this suggests that really your policy level as it exists now isn't really influencing prices at all. So in that case, what do you do to reach your target?
Yeah, no, I don't think that's right. I mean, again, the relationship between slack in the economy and inflation is weak, has been weak. The coefficient is something like 0.1, so it's much, much lower than it used to be, but I don't know that it's gone down any more in the last decade. It just is quite faint, but it's still there. I mean, you can see it. If you look at where wages were 3 or 4 years ago, they were running around 2%, and now the whole group of different wage measures that we monitor has moved up to 3 and 3.5%, and that suggests tightening. The same thing is true, but much less true of inflation. The relationship between, in a way, the wage Phillips curve has a higher coefficient than the price Phillips curve does. But we do still see some relationship, and that's what you're seeing in those numbers.
Mr. Chairman, Steve Leisman, CNBC. You've used the analogy to 1998 to describe the rate cuts we just went through. And I'm wondering if we can sort of continue the analogy. Within 7 months of those 98 rate cuts, the Fed took them back and then some. So were those kind of rate cuts the kind that you need to take back? Or are we at a place now where we're at a neutral rate? Take back, I mean, if those risks that you say we're cushioning from don't materialize in the way you think. Or is this now a new sort of steady state for the economy at this rate? This is the right rate for the economy that you see going forward and don't need to take those rate cuts back?
So there's similarities, conceptual similarities, I think, between the two instances during that long expansion, I guess in 95 and 98, when the Fed cut 3 times only to resume raising rates. And the notion just is that the economy needed slightly more accommodative policy, but it wasn't the end of the expansion, right? And that's the same situation we believe we're in here. So we did in fact turn out to do 3 rate cuts. That wasn't in the plan, in any kind of specific way at the beginning. So that's the same. What's different is you have very different structural characteristics in the economy, particularly around inflation. So now, as you can see, inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. And by the way, it's a good thing that we think we've learned that unemployment can remain at quite low levels for an extended period of time without unwanted upward pressure on inflation. In fact, we need some upward pressure on inflation to get back to 2%. It's quite different in 95 and 98 when there were those 2 adjustments. So I would say similarities and differences.
What?
BIS concluded in, I did the same thing as Howard. Michael McKee, Bloomberg Radio and Television. The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets. There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions. And one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates. We have the tools to accomplish that, and we will use them. The purpose of all this is not to eliminate all volatility, particularly in the repo market. So taking you back, as you know, we very gradually allowed the balance sheet to shrink. We slowed that gradual pace by half in March, and then we ended it in July. Meanwhile, we had surveyed all of the banks, and particularly the large banks who hold a lot of the reserves, and said, what's your lowest comfortable level of reserves? We got those numbers, we added them up, we added a buffer, and it came out sort of at a level that was well below when we were in September. And yet, we saw actually in September that the markets acted as though reserves had become scarce. So what had happened was that liquidity, which actually existed, didn't flow into the repo market, and that had effects on the federal funds rate. So the question is, why did that happen? And we've been very carefully looking at the reasons why that might have happened. There are payments issues. There have been a number of supervisory and regulatory issues raised. We're looking carefully at those. We're open to ideas for modifying supervisory and regulatory practice in ways that don't undermine safety and soundness, and a number of ideas are under examination there. To go through it sort of in time, we started off really on September 17th with overnight operations. By October 11th, we had created and put into effect a plan. That plan is in effect. It's working. I think for the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. So you asked about year-end. Temporary upward pressures on short-term money market rates are not unusual around year-end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been, essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo, and at the same time we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like those bill purchases are going well, just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year end as well, and prepared to adjust our operations as appropriate.
The follow-up to that would be, where are we with the possibility of a standing repo facility?
So on the standing repo facility, as you know, we've actually had a couple of meetings where we've discussed that. I think the standing repo facility is something that'll take some time to evaluate and create the parameters of and put into place. At the moment, what we're focused on is, we're now focused on year end. I should also mention that after year end, the sense of it is that as the underlying level of reserves moves up because of bill purchases, as that happens, there will come a time when it will be appropriate for overnight and term repo to gradually decline. We can't know today what the timing of that will be, but that's the way we see it going over time.
Heather Long from the Washington Post. A number of your colleagues have said explicitly that they do not think the FOMC should raise interest rates until core inflation is back at 2%. They think there should be a rule. Where do you personally stand on that?
Well, as I mentioned actually at the last press conference, we think our policy rate is appropriate and will remain appropriate as long as incoming data are broadly in keeping with our outlook.
Somebody asked the good questions.
And in order to move rates up, I would want to see inflation that's persistent and that's significant. A significant move up in inflation that's also persistent before raising rates to address inflation concerns. That's my view.
So is this de facto policy of the committee then? I guess I'm wondering why it's not sort of codified in a statement.
We haven't tried to turn it into some sort of official forward guidance. It happens to be my view that that's what it would take to want to move interest rates up in order to deal with inflation.
With New York Times, just following up on Heather's question. So if you look at the SEP today, it looks like inflation is never overshooting 2% and is only getting up to 2% by the end of 2021, yet rates are increasing in 2021. So I guess how do we square that circle with interest rates increasing before inflation ever really moves up in some meaningful overshooting way?
So I think what you're seeing is you've got a full year of the median being flat, which is, we think, accommodative, modestly accommodative, and inflation not moving up very much, as we've discussed. And that underscores, I think, the challenge of getting inflation to move up. The committee has wanted inflation to be at 2%, squarely at 2% ever since I arrived in 2012, and it hasn't happened. And it's because there are disinflationary forces around the world, and they've been stronger than I think people understood them to be. In terms of those out-year rate increases, what you're looking at rate increases more than a year into the future, and people will have their own explanations for why they do that, but none of us have much of a sense of what the economy will be like in 2021. So I think what may be behind some of that is just the thought that over time it would be appropriate, if you believe that the neutral rate is 2.5%, it would be appropriate for your rates to move up in that direction. I will also say to you that a number of people wrote down, and you can't see this at this level of detail, but today, but a number of people did write down overshoots of inflation as appropriate under appropriate policy.
Brennan Greeley from the Financial Times. Given that inflation, whichever measure you choose, has either sort of remained where it is or not increased over the past year, as you've been dropping the policy rate, what is it that gives you confidence that the Fed has the tools to get inflation back up to target or even overshoot, as you just indicated that some people are considering doing?
Well, it's just that there is still empirically, by many different, by the work of many different analysts, there is a relationship between resource utilization, by which I mean unemployment, and inflation. It's just
bonds continuing to push
weak.
up here.
By the way, that's
Treasuries,
not a bad thing.
gold
That means
pushing
that we
up,
can
so a
run
lot of risk on
at low levels of
assets for sure,
unemployment and have a
pushing up
historically
here.
good, in some dimensions, labor market without having to worry about inflation. It also means, though, that it's not easy to move inflation up. Now you say, why is there confidence? I mean, I would say there's more humility than there is confidence in this at this point.
TLT
It's been
climbing,
very challenging.
pretty much everything
to get
risk
inflation
is,
to be at
moving
target.
up
If you
here.
look around the world, the United States of all major economies has been closest to it, but still hasn't quite been able to achieve it. And I would also point out that this year, which has been a good year for the
Market
economy,
not giving it back, though.
core inflation is actually running at 1.6%, whereas it ran close to 2% most of last year.
Fight to the death.
So it's a real challenge, and but I think we're using our tools as best we can to meet that challenge.
Nick Timmeros, The Wall Street Journal. So, Chair Powell, I want to ask about the framework review, which obviously entails some kind of debate around allowing an overshoot of the 2% target. And in that context, is merely saying that you want inflation to rise above 2% a sufficient strategy for getting inflation to stay at the target? Or would it compel some kind of policy action beyond deferring future rate increases to achieve that outcome, if that's the direction in which the committee goes? In other words, it's one thing to accept inflation rising on its own opportunistically, but if inflation does not materialize, would a change in the framework necessarily make it easier to generate higher inflation?
Well, I think the answer to the question of whether saying it is enough to create credibility, the answer to that is no. And I think you have to back that up with policy that supports the outcome. And that's what we're trying to do. And so the changes that we're looking at to the framework are I think they take all of that on board, but what they are designed to do is to strengthen the credibility of that inflation target, but only if followed by policy. Ultimately, it will take time to move inflation expectations up from where they are, which appears to be a bit below 2%, will not happen overnight. It'll have to happen over time as credibility is built. The Fed has great inflation credibility, but inflation expectations are anchored at about their 25-year average, which is a few ticks below 2%.
We talked a lot about inflation. Edward Lawrence from Fox Business Network. We talked a lot about inflation. I want to ask you about uncertainty. With the House announcing that they will ratify USMCA and Canada and Mexico signing off on it, do you see that uncertainty easing now so the business investment could pick up? Or are the trade tensions with China just that big elephant in the room where you might not see those business investments pick up?
Well, I did see the news today that it appears there's an agreement to move forward to a vote on USMCA, and of course it's not our role to comment on particular trade policies or criticize them one way or the other or evaluate them. I will say though that if the deal were to be enacted, then it would certainly remove some of the trade policy uncertainty, and that would be, I believe, a positive for the economy. And I'll say the same thing about the negotiations with China, which haven't reached that point yet. We've been hearing from our people that we talk to, the many people and businesses that we talk to through the reserve banks that wind up being written up in the Beige Book, and they've been telling us all year, for a year and a half really, that trade policy uncertainty is weighing on the outlook. And I do think that, again, without commenting in any way on the process or the content of the agreement, I think that removal of uncertainty around that would be a positive for the economy as well.
Is one uncertainty bigger than the other? Do you see, not commenting on the deals themselves, is one uncertainty for business?
I think you can, I think you can see that what's been moving, one way to look at it is what's been moving financial markets. It's been news about the negotiations with China, not so much USMCA. I think the difference between NAFTA and USMCA is smaller than the difference between current, arrangements with China and what's being negotiated.
Hi, Matthew Bosler with Bloomberg. Chair Powell, the Fed policy review this year has largely been discussed in terms of the inflation side of the mandate and the need to shore up inflation expectations. But it seems like the message you've been getting from the Fed Listens events and also something else you've recently acknowledged is that the Fed has also been systematically overestimating labor utilization throughout this expansion. So I'm wondering if you could talk a little bit about the extent to which the review is looking at the employment side of the mandate as well. Are there any possibilities, for perhaps systematizing a more asymmetric reaction function with regard to unemployment? Thank you.
Yeah. So the focus really is on how to use our strategies, tools, and communications to achieve both sides of the mandate. You're right, though, that we've talked here a lot about inflation, and I think that I think more broadly, over a period of years, the natural rate of unemployment is lower. It's in estimates, not just at the Fed, but broadly among economists, labor economists, have seen that the connection that we can sustain much lower levels of unemployment than had been thought. And as I mentioned, that's a good thing because that means we don't have to worry so much about inflation, and you see the benefits of that in today's labor market. The Fed Listens event are about inflation to a much lesser extent than they are about maximum employment. If you've listened to or attended any of those, the discussion, we always focus on inflation as well, but the discussion is really around what's happening in low and moderate income communities, and among small businesses. And I think you get a perspective which, we were already getting that from our extensive outreach to community groups and such, but it was helpful to get it in the context of a monetary policy review. And I think that the fact that these communities have such high levels of unemployment and low levels of labor force participation tells you that there is slack out there. And I think that does also inform our understanding of what we mean by maximum employment. And it's been a very positive. I would say that the Fed Listens events have been extraordinarily positive, and they're certainly something we'll repeat. You also see from the business perspective that companies are taking all kinds of measures to look through things on people's resume that would have perhaps disqualified them in other kinds of environments. Training is moving up. You hear just a lot. There are a lot of things going on that suggest that people at the margins of the labor force are being pulled in and being given chances, which is a great thing.
Victoria.
Sorry, if I could just follow up briefly, is there any way to sort of systematize these insights, do you think, in terms of, we talk a lot about, for example, make-up strategies on the inflation side. Is there anything similar you could do on the employment side?
I think we have kind of internalized, and this isn't news for today. This is something we've been saying for several years. You've seen us moving down our estimates of maximum employment. In fact, it's already understood, I think, that there's more. Even though we're at 3.5% unemployment, there's actually more slack out there, in a sense, and the risks of using accommodative monetary policy, our tool, to explore that are relatively low. I think we know that, and I think the review certainly underscores that, but that's a very important insight.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask more about the repo issues and what you all are doing beyond open market operations. Are you currently, for example, telling examiners not to prefer reserves over treasuries for supervisory purposes? Are you talking to the Treasury Department about maybe reducing the level of volatility in their account at the Fed? And on the standing repo facility, is it that you would be inclined to do it, but you need to figure out the details, or what would kind of drive the decision on whether or not to do that?
So on treasuries versus reserves, we've done a ton of work on that. We've talked to supervisors, and it's interesting. If you look at the banks, they're all over the place on the composition of their buffer. So you have a business model, and that business model suggests what your stress outflows will be, and that suggests what your buffer should be. And you see them making quite different choices. Some of them have lots of reserves and fewer treasuries, and then they change their mind and they switch. So it's not obvious that there's one thing happening there. Notwithstanding that, we've gone out to try to understand that, talking to the supervisors. In terms of the TGA, we have not tried to pull the TGA into this yet. We've taken it as exogenous. I don't know that at some point we won't have those discussions, but Treasury, we want Treasury to be able to have the cash that it needs, and then we are essentially taking that as exogenous to our work. There may come a time when we talk about that, but we haven't done much of that. Standing repo facility. So your question on that is, what are we thinking about it? What are we? I think we are more focused, frankly, on the bill purchases, the year end, and also the review of supervisory and regulatory issues that we're digging into, and because we think these are structural.
Well, this was uneventful. I mean, it's good though. I think this is where we can start to get some volume to move back into the market.
Is already there to flow more freely. Perhaps by making fairly straightforward.
I mean, a few things like the USMCA. Those are some comments I wanted to
so
hear.
We're working hard and fast, but those are things if they take rule changes, it'll take a notice.
The market's just up and down and all around though,
and things like that. Those things
don't
take
know
time.
what
These
to
things
do.
that we're working on now, though, like going through year end.
And you guys probably hear those noises. I was just doing some scalps. I had basically straddled the SPX
those are things
and
we
the
have
VIX.
to do right now and are doing.
Hi, Chris Rugaber at Associated Press. I wanted to ask, the only change in the statement was a drop in the reference to uncertainties around the economy. You seem very confident, or it implies there's a lot of confidence that those uncertainties have gone away. What caused you to make that change for this statement? What were you looking at that seemed to be so much lower?
We did actually, if you look at the statement, you'll notice that we did call out global developments and muted inflation pressures later in the statement. And why did we do that? Those are the things that we've been monitoring all year. We've put now in place policies that we think are appropriate to address those things. So we're not revisiting that. But those are just key things, and they haven't gone away. So we thought it was appropriate to mention them there. Still subject to the idea that for us to change our stance, we would want to see a material reassessment of the outlook.
Well, just to follow real quick, on the material reassessment aspect, are you worried that has set too high a bar for potential cuts next year? We were talking about rate hikes, but no Fed policymaker seems to foresee any cuts next year. Some economists do. Does a material reassessment mean you need to see data actually worsen? Does it reduce your ability to act preemptively the way arguably you did this year?
So, one thing that we're mindful of is that we've cut rates 3 times since July. That's 75 basis points worth of cuts. And we do believe that monetary policy operates with long and variable lags, and that it'll take some time before the full effects of those actions are seen in the economy. So that'll take some time. So that's one reason to hold back and wait. And we think we took strong measures. In fact, if you look at more broadly at the Treasury yield curve, it has moved more than 75 basis points. So you've had quite a significant move in the direction of higher accommodation. In terms of what is material at the end of the day, I would just say whether or not a change in the outlook merits a policy response will be a collective judgment of the FOMC. There isn't any single factor that will determine our decisions. We'll look at a full range of data and other information bearing on the economic outlook.
Thank you, Mr. Chairman. Scott Horsley from NPR. You started out by talking about Paul Volcker, who obviously cast a long shadow. I wonder if, in hindsight, that shadow was too long, and if in the decades since his tenure, and in particular last year, if the Fed was too quick to raise interest rates to attack an inflation boogeyman that didn't materialize.
This wouldn't be my response will not be about Paul Volcker, but although you started with Paul Volcker. So if you look back at 2018, I'll just take you back to the beginning of 2018. We had an economy growing at 3%, we had inflation at 2%, and we had $1.5 trillion worth of stimulus arriving, and the federal funds rate was 1.4%. So it wasn't that. So we moved policy up during the course of the year. We never got policy even at the level of what we thought the neutral rate was at the time. So there was no sense of it being restrictive. We took steps to make it less accommodative, and that seemed to be the right thing. It still seems to me to be the right thing in hindsight. The idea that we were trying to, slow the economy down, we were really just trying to get near neutral. And even with the last rate increase a year ago, we were still meaningfully below the median estimate on the committee of what the neutral rate was. So policy was always accommodative during the course of that year. I think what's happened is obviously the facts on the ground have changed. You saw the global economic slowdown begin in the middle of last year, gather force, and then continue to go on this year. So you've seen a continual weakening. Just look at the IMF's forecast of growth from the spring of 2018 and compare them to now. You've had quite a significant, that does affect us. I think also the trade situation was just beginning in the middle of 18, and I think it has had, I think there'll be very, very wide range of estimates of the effect, but I think it's had a meaningful effect on output just through the uncertainty channel and to a lesser extent through the tariff effects. And again, that's not to make a judgment. It's not up to us to make a judgment about that. So that would be my story.
Chair Powell, Donna Borak with CNN. To follow up on Edward's trade question, could you talk about what you would imagine the economic effect would be if negotiations with China were to fall apart, and how the Fed might be able to support the economy in that event?
You know, I wouldn't want to speculate on a hypothetical. I would say we'll just have to see. We look at a range of factors, and we've as I've said before, we try to look through the volatility in trade news and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility and you know, things that can change back and forth, as this has happened, as is probably typical of a large, complex negotiation. So in terms of, you know, again, I don't want to get into hypothetical outcomes, though, if that's all right.
I'm just wondering, you met with the president last month. Did you have any advice for him when it came to this, and did you express some concerns about potential volatility and the impact of the economy on, given all this?
You know, I'm going to stick with my predecessor's longtime practice of not discussing private meetings with elected officials, or other officials, really. But thank you.
Thank you. Virginie Montet with Agency France Press. Yesterday, Democratic leaders in the House have launched an impeachment process against the president. Have you mentioned these developments within the committee today as potentially presenting some risk for the confidence in the economy?
No, we have not. We don't consider things like that.
Mike Darby with Dow Jones Newswires. Does the Fed's dot plot still serve a useful communications purpose, or do you feel that it might be time to retire it or change it in some fashion?
Well, I think properly understood, it can be useful, but that's been a challenge. You know, I think properly understood to me means looking at what it is and not at what it isn't. And what it is it's an expression of the thinking about individual committee members about appropriate monetary policy and the path of the economy. Remember that we write all that down and we send it in and it gets compiled, but we don't discuss it at the meeting and we don't negotiate a plan. There's no agreement, there's no plan. And I think particularly at inflection points, it's hard to convey the reality, which is that policy is always going to depend on the economic outlook and changes in the economic outlook. And when the economic outlook is changing, the dots they're just not a consideration. We're going to do what we think is the right thing for the economy. And if the dots that we did 6 months ago or 3 months ago don't agree with that, that's not even in the conversation. So it's more, but it can be useful, and I think, but as I said, it's been a challenge, and so I do like to say if you focus too much on the dots, you can miss the broader picture.
Greg Robb from MarketWatch. Chairman Powell, many people seem worried that the framework that you guys are working on is going to be, the results are going to be less rather than more. And people keep coming back and saying asking why you took off like a 4% inflation rate off the table, even when it started. I mean, as you said, if going around the country for all the listen events, I don't think I heard anybody worry about a 4% inflation rate or think that higher inflation rate was going to be a problem. So where does that concern come from? Is it members of Congress that have said this?
No. So let me say we've been working on this all year, and we're just at the stage where we've had a really interesting discussion about the various tools that we have at the October meeting. At this meeting, we talked about the way monetary policy affects different groups in the economy. So we talked about the Fed Listens events and some very interesting research. So we're just getting to the stage where we're looking at conclusions. You know, what do we take away from all this? And those things, many of those things would wind up as changes, if you will, modifications to the statement of longer-run goals and monetary policy strategy. I think that process will take until the middle of the year. But we want to approach it very thoroughly and very carefully, and that is, in effect, that is our framework document. And I wouldn't prejudge. No one. I believe we will be able to to reach a successful conclusion and make meaningful improvements. I do. In terms of 4%, so that's, I think it's premature for people to be saying that this isn't going anywhere. And if you define going anywhere as a 4% inflation target, let me talk about the 4% inflation target. So I'll go back to the point that just saying words is not itself credible. So I think if you said we're raising the inflation target to 4, what would be the effect of that? I mean, where's the credibility in that really? You haven't been able to get it to 2. So I think you need to lower your sights a little bit. I also think is 4%. You'd have to ask the question: is that really, price stability? Is that really price stability? Is that within our legal mandate? I mean, I think it's a fair question. So I think I'd like for this review to come out with a set of positive results. Meaningful improvements. It doesn't mean it has to solve every problem going forward. We want to have this be a successful exercise where we meaningfully improve our monetary policy framework. These things don't tend to move in a lurchy way. They tend to evolve. But I think, and if we do this then in a few years again and again, and things like that, then then at least we're moving in a good direction. And I think we will be. I'm confident we will be.
Don Lee with the LA Times. Chair Powell, you've had a busy year, and I'm wondering, as you look back, what things you might have done differently, and whether there are any lessons that you would take into next year.
Well, I have to say my total focus is on right now and getting policy right and thinking about next year, thinking about what's the economy going to be doing. I like where we are in policy. As I mentioned, I think our policy stance is appropriate and likely to remain so, as long as the outlook is broadly like this. I mean, it's too long of a question. I don't know how to get after that. There's a lot of learning that comes into from the economy every year, and in the way we do our jobs, and we're always going to be trying to learn lessons.
I mean, are there any particular surprises, whether it's the economy or how markets or financial things?
Well, I didn't, obviously, didn't see, and I don't think anybody saw coming the challenges that we faced this year. I think they were a surprise. I think toward the end of 2018, there was still a sense the economy was growing at around 3%, and didn't expect to face the challenges, but I think we did face them, and I think I'm pleased that we moved to support the economy in the way that we did. I think our moves will prove appropriate, and again, I think both the economy and monetary policy right now, I think, are in a good place.
Nancy. And Nancy Marshall-Genzer from Marketplace. Chair Powell, why aren't we seeing stronger wage gains? Wages are growing more slowly now than they were toward the beginning of the year. Why is that?
Well, wage gains have moved up a bit. If you look back 3-4 years, you'll see wages were growing around 2%. Now you see them moving up, more at 3.5%. So why aren't they growing higher at a faster rate? And it's a couple of things. I think there are a range of explanations. One would be that productivity has just been low. So wages should go up to cover inflation and productivity. Productivity has been low, and that is very likely to be holding back wages. I also think there are other possible potential explanations, such as globalization can be the idea that you can manufacture or even provide services anywhere in the world to anywhere in the world. I think that hangs over the wage setting process and everywhere pretty much. You don't see there isn't the kind of traction in the wage market that even in a tight labor market. Another thing is, though, that the labor market may not be as tight as we had thought it was, I think there are many possible explanations. I will say, though, if you look for example at non-supervisory employees in the labor report, their wages are going up at 3.7%. And so you do see, and wages are going up the most for people at the lower end of the, that's been true for the last couple of years, lower end of the wage spectrum. So you do see wages moving up. They're not moving up at very high rates. And again, at the end of the day, that probably has most to do with productivity.
Just as far as the market not being as tight as you thought, are you saying there are still more people on the sidelines who could join the labor force?
Yes, and I would also say that if you ask people, and we did ask people, what do you think the natural rate of unemployment is? People were writing down numbers in the 5s, and then they were writing down numbers in the 4s, and now unemployment's been in the 3s for a year and a half, and we still see wage inflation, as you mentioned. The level of wage inflation has actually moved down, although there may be compositional effects in that number. That may be, to some extent, about younger workers coming in at lower wages than retiring workers. But that shouldn't have much of an effect, actually. So why is that? It may just be that there's more slack in the economy. And I think we are seeing that. We're seeing, really it showed up through higher participation. For many years, we've thought that there's a trend decline in participation. Notwithstanding that, against that trend, we've seen prime age participation moving up pretty steadily over the last 2 or 3 years. And it's a very positive thing, but it does sort of provide more labor supply, meaning a less tight labor market.
Hi, Hannah Lang with American Banker. Thanks for being here today. I just wanted to ask about the Community Reinvestment Act, since the FDIC and OCC may potentially join together for a proposal without the Fed. Are you concerned that this might cause confusion, and how would the mechanics work if this proposal is finalized without the Fed?
So, we think the CRA, we know the CRA is a very important law, and we're strongly committed to the mission of ensuring that banks provide credit throughout their communities, particularly addressing the needs of low and moderate income households and neighborhoods. We also think it's time for modernization. We've thought that for some time, and we worked very hard to try to get aligned with the OCC really on a proposal. And my hope is that we can still do that. I don't know whether that'll be possible or not. We'll just have to see. And if we can't, I'm not sure what the path forward would be. We would certainly not want to create confusion or sort of tension between the regimes if they do turn out to be slightly different regimes. So that's something I hope we don't have to face, but we will if we have to.
Hey, Brian, for the last question.
Hi there, Brian Chung with Yahoo Finance. So before the July meeting, you said something kind of colorful. You said to call something hot, you would need to see some heat, referring to the labor market. So to expand a bit, I guess, on Nancy's question, seems like the wage Phillips curve has been pretty well explored already. But what would you need to see to call the labor market hot in that case? Would it be some sort of change in either the headline number of gains or in the unemployment rate?
Really, wages. I mean, there's so many other measures that suggest that the labor market is, I'd like to say the labor market is strong. I don't really want to say that it's tight. Someone asked me a question about a hot labor market. That was in the Humphrey Hawkins hearings. So I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, it should be reflected in higher wage increases. So it does come down to that. We look at countless measures of labor market, labor utilization, and there's so many, it's too many to count. But the one that is kind of suggesting that it's a healthy number, that the sort of 3.1% average hourly earnings number is a decent number. 3.7% for production non-supervisory workers is more healthy. Ultimately, though, we'd like to see, to call it hot, you'd want to see heat. You'd want to see, higher wages.
Thank you.
Thanks.
Well, well, well. That's what the fat lady sings, kids. So I caught a nice little couple of bounce plays in there. Just little scalps. Man, I just want to be set up for for the big ones. It just sucks. But yeah, so hopefully what we'll see. Hopefully we'll start to see some volume pick up now that this is kind of out of the way. It'll be interesting to see where we kind of go from here, guys. Gold picked up quite a bit while we were in the middle of that here. You can see, so it hit a high of 1483.50. It started to sell off just a little bit here. Bonds have backed off too, but it hit clear up at a 159.02. I mean, that's crazy for just a couple of hours. You can just see it just had this slow climb up all day, peaking out during that speech there in the bonds. So yeah, we did hit a high of 3144.50, and then we backed down to 3141. Will definitely be interesting to see what happens after hours today, going into tomorrow. 3141 being the key level here. That's going to be a very critical level today, and has been. Oil, continued to rise back after the big drop this morning. It's not back up to where it was. The other move, and I will post this over in Discord in a second, is Tesla filled the what do we want to call it? The Cybertruck fiasco. I don't know what to call it, but we'll post that. So Addict and I both were alluding to this and showing this morning. NVIDIA is continued to push up. It is now pushing above the 4-hour upper Celt. If it can close up here, this is absolutely going to be a nice bullish push on that. What else? Skyworks is holding nice over 5% still. On the FANGs, you can see we had this little swoop-T on Facebook, but it's now pushing up about 0.8%. Netflix, after the sell-off and then bought back, it's just been kind of, so today it's been slowly grinding itself, just kind of chopping around, but it's slowly pushing up. It's still up almost 2%. Google and Amazon just kind of floating around today. Google being, just absolutely nothing. Look at this. For a $1,300 product, this is just weak sauce, right? Amazon kind of doing similar. It's up about $8 is all. But you can just see it just, it had a little bit of a down tick. So it had a little bit of a up move in the pre-market, sold that off pretty quick in the middle of today, and then started getting bought back up. Microsoft did the same thing. It sold off all the way down to 150.33, and now we're back up to 151.72 as I'm speaking. Apple hitting that high this morning of 271.07, which is an all-time high, and then backed off and then kind of chopped around the rest of the day. It is finding a little bit of balance here and support at VWAP, and it's pushing back up now at 270.57. As far as, let's go over to, so Boeing turned around its sell-off from this morning. It is now trying to close above the lower Celt on the 4-hour. Roku just kind of doing not much of anything. However, I would like to point out that if you look across on the 4-hour here, we've kind of just stayed in this this little range here. This is good for Roku. This is actually, in my opinion, this is still bullish because it's been consolidating here. I could see Roku any day now. I'm going to be very, very patiently awaiting for that next big push up. It could be pushed down on some bad numbers or something like that, but I'm actually still very bullish on Roku. So I will post some of the trends. I've got some charts on it with the trend lines drawn up. I know ATG's got a really good couple of charts for it as well. So one of us will post those in there. Activision having a pretty good day again after yesterday's awesome run. Tesla, like I said, I'll post that here in 2 seconds. I'll post that over in Discord so you guys can see the before and after the Cybertruck smash. Hold on 1 second, guys. I missed that. There we go. Qualcomm having a great day too, up over 3% as well. BABA still holding that nice support on the upper Celt on the 4-hour. Bidu finally pushing through resistance on the middle Celt and the 30 MA. on 4-hour, and AMD starting to finally turn this around. I'd like to see this up above at least be in the positive. If it at least, I mean, it's only got 2 cents to go, so it'd be kind of nice to see that end in the green, as well as McDonald's doing the same. It does have all of this resistance here, which you can see that not only is it resistance, but there's now a price level drawn in here, which I will have to add to this chart. But it really needs to push above that today to close bullish for me. I don't think it's going to happen, so I'm still not very bullish on McDonald's. So there's kind of what we're looking at. Bonds are kind of selling off a little bit here, as well as gold is too. Gold, they're saying, was pushing up because of the China news, blah, blah, blah. Who knows? Palladium back at all-time highs as well. You can see the add divergence line just absolutely just ripped from 114 all the way back up to 700 here. So we basically went all the way down about 600, and now it went all the way right back up to where we started the day. So actually, if this holds for the next 30 minutes and then after hours, this is somewhat bullish. It needs to hold this 3141 though. It cannot lose that. Especially the SPX needs to hold because they're slightly different. Because the S&P is 3142 and the SPX is 3141. So you see there's just like a little bit of a difference, but in the S&P it needs to hold this 3141 basically to end bullish for me. So that is that's where it's at. I'm going to look at a couple of other things for some possible swing trades. I will post a couple things in Discord. I will still stream through the end of the rest of the day here for the next half hour. But I'll try to see if we can find some nice swing trades into tomorrow. And we'll go from there. And we'll talk about the Fed stuff later today in Discord. But there's really not much to talk about. There was a couple things that I think people are skipping and missed over, but I will bring that up as we get more into that. So that's where we sit, guys. Hope everybody kind of held in there, and we'll see what we can do.